Hello and welcome to Commodity Champions. And what a week it has been, where we've seen huge swings come in for the gold and silver prices. We've seen the crude prices headed for a weekly upside close, and the soft commodities have continued to gain as well. I'm Manisha Gupta, and we'll start with gold first, where we have seen huge swings come in. This is headed for a first weekly decline in last 10 weeks. If you look at the gold prices, well, we already have lost something like 7% from all-time highs that we saw in the previous week, and silver prices are down by 13% from its all-time highs as well. So the demand clearly has been on the weaker side. We've seen even some ETF redemptions come in. But from here on, where is gold headed? How should you be trading it? For me, for joining us now is Philip Newman of Metal Focus. Philip, thank you so much for joining us. First of all, most people would say that $2,000 per ounce was the target for gold by the end of this year. We've already done that, and we've seen some profit taking as well. And the huge swings that we've seen in this week, what is your sense now? Are we due for some more correction, more volatility? Where are we headed from here on?
Oh, that's a very good question. I think the price, both gold and silver prices, are being driven by institutional or professional investors. And what that means, I think by definition, is to expect high levels of price volatility to continue. And even though we've had this consolidation, the profit taking, as you put it, it's quite possible we could see more profit taking. But I think that doesn't change the underlying strength and the positive view that we have towards these prices, both this year and for next. And so we think that bullish tendency is certainly still intact for both prices.
So, Philip, would you say that we've done the highs of this year, or are you looking at more all-time highs before we end this year?
I think our target for this year is a high of around 2,100. So that would suggest that we could see further strength in the coming weeks. I think that's quite possible. So I think that's something we would look for, both and silver as well. Silver could perhaps get up towards $30 this year. So I think we could see new highs in the coming weeks and months.
So as you said in the very beginning itself, Philip, that much of this move is driven by institutional traders and speculators. We've seen a lot of investment buying also come in for gold bonds. People are buying mining stocks. Gold ETFs are near all-time highs as well. Do you see any redemptions coming, or do you think investors will hold on, since this is a structural bull run, as we call it?
I think for some investors, they will be concerned about how the further upside that we could see for gold. So that does, I think, give you the sense that we could see further redemptions. I think it's possible, but we don't think those redemptions could be that significant. And from a price point of view, investors, they would have seen gold getting up past $2,000 and getting now towards 1950 or thereabouts. I think many investors would take that as a buying opportunity. And if we look further ahead, the upside that we see, I don't think will be a straight line going north. That volatility will continue. And I think you could see even gold falling below $1,900. But again, from our point of view, those dips will be short-lived. The bullishness, that demand for a safe haven, given the negative or the very close to zero interest rate environment, that's not about to change anytime soon. And so I think with that environment, with the uncertain economic backdrop, with the trade war between the US and China rumbling on, especially in an election year in the US, I think all of these ingredients tell us that investors will certainly be very well disposed towards gold, looking for those price weaknesses, those price dips to come back in. And I think that's why we're quite positive in that environment.
Philip, how do you look at the investors? Because, let me tell you about the Indian markets. It's under-owned when you look at investment side of it, gold and silver both. But in the previous month, we've seen 60,000 more investors come into the folds of gold ETFs. If you look at this year, 270,000 investors who have added up, in the rank when it comes to buying gold ETFs. So until now, India was buying gold and silver into physical, but gold clearly has more takers when it comes to financial instruments here. Are we looking at these kind of trends in other countries as well?
I think one of the issues one has to bear in mind, of course, because of the COVID restrictions, because of the lockdowns that we've seen, I think that has made it more difficult in some markets to buy physical products from a retail point of view. And I think that's certainly lent itself to other investment vehicles. But if we look at the likes of the US market, where ETFs have done incredibly well, but then again, so has demand for bullion coins and small investment bars. And we've certainly seen shortages of some products, with other products going on to extended lead times. So I think what we can say is demand for a whole variety of products, I think, has held up very well. But I think those restrictions have certainly played into benefiting digital gold, for want of a better expression, or paper gold in certain markets.
Going forward now, I mean, as you said, Philip, there are various reasons on why we could see further support in gold and silver. It is a US presidential election year. We still are looking at huge stimulus measures coming in. The COVID numbers are still rising. The dollar is still on the weaker side from where we saw it in the month of March. Which factors or fundamentals that would you really watch keenly on for the next cues here?
Well, I think with the economic backdrop still being quite weak, central banks, I think, have been incredibly cautious, I think rightly so, at the risk of derailing that very fragile recovery, for late 2020 and 2021. And I think investors will see that stimulus either increasing or certainly not being tightened or removed from the market. And I think with that backdrop, I think that will be a very positive feature for investors to really, I think, look at where can they put their money. I think that will certainly discourage them from investing in bonds. And with that safe haven requirement still being there, I think that wider environment, therefore, will still be gold supportive. I think those are the factors that we're looking at, and hence why we're still positive for gold and silver prices, as I mentioned earlier, not just this year, but certainly into 2021 as well.
Philip, how long do you see the gold bull run continue? Most people say it's an 8-year run and it started in 2018, could go on to 2023. What has been your sense?
That's a very, very good question. So I think we will certainly see strength this year. We'd see strength into 2021. I think as you come into 2022 and you start to see the economic backdrop starting to improve, I think at that point, we could see central banks starting to gently tighten rates. And I think at that point, we may start to see liquidations gather momentum. So I think that's something we're certainly watching for from a medium, longer term point of view.
Philip, for the longest time, India and China have been seen as large consumers of physical gold, and some of the cues do come in from here. But because of the lockdown, this year is completely a washout when it comes to physical buying, especially in India. So what are the trends? How do you look at the Asian physical markets now?
Well, you're right. I think the lockdown has unfortunately had quite a dramatic impact on the Indian gold market. You think of the likes of, Akshaya Tritiya, unfortunately being from a gold point of view, obviously, being exceptionally weak, and that demand is foregone. That demand simply doesn't come back later in the year. I think what we would look for, though, is, what was the marriage season, how that developing in Q4. Of course, we're expecting, very decent monsoons, and I think that could be positive. So I don't think we are necessarily writing off the entire year, certainly not. But I think we're obviously very mindful about when those restrictions will be ended. I know speaking to my colleagues, they would tell me that they've been at home for, I think they're telling me, for 150 days. And of course, what that means for the gold market has been very weak. But I think both for India and China, we could, start to have, a better Q4. But of course, we're overlaying that with record gold prices. And I think that therefore places much more onus on the investment that we spoke about earlier. But I think we could see, as I mentioned, a better Q4, and therefore that could play out for perhaps a release of some pent-up demand in those markets, be it in Q4 or in Q1 next year.
All right, so the demand recovery could be coming in, not writing the entire year yet, and still bullish on gold and silver for this year and the next. And we aren't done with highs here, and all-time highs are still on card for gold, and silver prices could be running up as well. Philip Newman, thank you so much for joining us with your sense on precious metals. With that, we'll take a break. But when we come back, we'll talk about the crude oil prices, soft commodities, because they have been quite buzzing as well. Back, you're on Commodity Champions, and joining us now are our special guests on crude and soft commodities. On the crude oil prices, we've seen this week headed with a weekly gain. Declining weekly inventories, resilience in equities and a weak dollar have supported the prices. But looking ahead, will the crude oil prices continue to rise? The Energy Information Administration has lowered the demand forecast due to travel restrictions. How much will the lower demand hurt prices? To answer that and more, we have our guest with us. Joining us now is Paul Hicken, Associate Director Oil at S&P Global Platts. I also have with me Carlos Mera, who is Senior Commodity Analyst at Rabobank. Gentlemen, thank you so much for joining us. Paul, to you first. And the crude oil prices have been holding above $40 per barrel for some time now. We seem to be making higher highs. Is it more sentiment driven, or do you see the demand actually come back?
I think it's still in a delicate balancing act at the moment for oil and oil demand. If you think about certain drivers of that demand, if you look at jet fuel, for example, while it's only 8% of the oil demand complex, it's still under extreme pressure. It's been obliterated by COVID-19, and that's still a problem for the oil market, and that's in the back of the mind. Mobility trends is another one. You look at where gasoline and diesel, big parts of the oil complex, while that has shown pick up in a few months and brought oil prices up towards that $40 a barrel oil mark, at the same time, where does it go next? It's sort of stalled. Yes, there has been some optimism and they're buying on trends, but there is still a very narrow range right now in the oil market. And I think when you look at the key demand centers for oil demand, which is India and China, India is still under extreme pressure for demand. COVID-19 has been a real problem. And as a result, Platts Analytics sees 405,000 barrels a day demand contraction for India in 2020. And you look at China, now China's a very interesting one because that has shown some pickup. It has shown a lot of buying activity for crude. It's bought on, the refiners have been buying because it's been cheap, and also because they've got stocks to fill and they can stockpile that, and they've done that aggressively. But there are limits to that as well. And I think in the next few months, we saw from the China import data for oil, we saw that it's come off the June highs in July. And I think that trend could continue. And as a result, you see the limits of China's buying for oil, and that is going to keep a cap on prices.
So, Paul, what's your sense? Do you see prices hold around $45, $50 per barrel by the time we end this year? Do you see demand pick up?
I think still the $40 barrel range is where we're at. I think for the next few months at least. When you think about the OPEC side of the equation, supply side of the equation, OPEC plus, they're going to be bringing on 2 million barrels a day to the market from August, from this very month. And while that 2 million barrels a day may not equate to the actual 2 million, because you've got, for example, countries like Iraq and Nigeria have to make up some of the over-compliance, the under-compliance they made it previously, so they need to over-comply in August and September. So the 2 million barrels a day may not be the whole 2 million, but it's still going to be a significant extra supply come on the market. And then you've got to look at the shale in US production as well, and that's also a big factor in the market. How much will that rebound? Now, and we've had a lot of competing factors around that. At $40, $45 a barrel WTI, then some oil companies are making money, but not everyone. And I think the adage that oil companies may go bust, but their assets don't, is certainly true up until a point for US. But at the same time, investor appetite for going back into the fields and investing back into oil, then that would really require oil prices to come back up. And it's a little bit of a chicken and egg there, that when prices come back up, then you get the incentive to invest and to start producing in the US. But at the same time, while prices are $40 a barrel, then the incentive is a little bit more lukewarm.
The rising crude oil prices definitely are having an impact on the commodities as well, but at least the freight and the global trade is back. We've seen Baltic Dry Index also come to a 3-week high, so there are those numbers actually moving there. Carlos, this one is to you. When we look at the months of March, more March and then April as well, we did see the soft commodity prices decline quite sharply, double digit. But in the last 1 month, whether it's cocoa or coffee or sugar for that matter, we've seen prices gain up into double digit as well. How do you look at the shift, the supply chain disruptions? Some of the countries are still going back and forth with their lockdowns. What is the sense on international supplies when it comes to these commodities, and how do you look at demand?
Yeah, there was indeed a bull run over the last 24 weeks across agricultural commodities. Not all of them, but certainly cocoa was well supported, Arabica coffee and sugar, all quite impressive. And we are like in these commodities, we have fairly large stocks. So it's quite surprising to see commodities going up. And I think it's a combination of factors. One, undeniably, is the US dollar weakness that pushes the price in US dollars of all assets, and particularly commodities because they're internationally traded. But also demand has been good and better than expected. I mean, we can look, for example, at soybeans. China import demand has been increased several times by the U.S. Department of Agriculture over the last few months, and in the last WASDE in particular. But also, for example, if we look at company results for coffee for Q2, they were relatively good. They were actually very good for everyone selling at supermarket level, for the out-of-home sector. Well, they were not, of course, not great, but that was expected. But the forward guidance is very good, that they've been improving in the last few months after lockdown. And that sort of removed the expectation. You know, company results were not the bloodbath that they could have been for Q2 2020. And then a couple of bits and pieces, depending on which commodity it is. But it was very interesting to see the WASDE released earlier this week on Wednesday by the U.S. Department of Agriculture. They made very significant increases in corn and soybean yields, yet the market didn't react. We have record high yields of corn and soybeans, and they also increased demand so much that the overall effect on the market and the ending stocks was not there. And I think that has been more or less the story. Very good demand and also a little bit of dollar weakness.
Also, Carlos, would you say that the kind of stimulus measures that we've seen in the international markets, is that driving prices higher as well? I do understand your point about demand, but is it also about speculative moves?
Well, I think as well, we have seen a little bit more interest from index funds, and that we can track in the CFTC. Index funds have been buyers of agricultural commodities over the last few weeks. Maybe portfolio managers, pension funds, etc. They're probably hedging inflation with agricultural commodities. Obviously, coal is already very expensive. So whenever they see something very expensive, they probably look at sort of similar real assets, and agricultural commodities follow in that category. And we have seen very similar case back in 2009, following the global financial crisis, that people thought, oh, well, all these measures may cause inflation in the future, so we just go long commodities. And index funds is not the only vehicle to do this. I mean, there are a lot of, nowadays, many more than back in 2008-9, there are many more exchange-traded funds that can go long agricultural commodities, sometimes with leverage. So I think there's a lot of that taking place.
That exactly is my question to you as well, Paul, because we've seen crude prices hold around $40, even as there have been various reports, various numbers which haven't been supportive of this number. Would you say it also is about crude ETFs, easy liquidity, people making or investors making long positions in many of these commodities?
I think that's an interesting question, Manisha, and I think the structure of the market, it's a tricky one, because for oil, you've got to look at things like storage, which has been a big factor in the market. We had up back in April and coming into May, there was talk of storage tanks filling up, an unprecedented amount of crude washing around in the market, whether that's in land and then going on to ships as well. And the VLCCs, the super tankers, the large tankers, they really took up the slack and provided some ease into the market until OPEC Plus came in and provided those supply cuts. So storage has been a big aspect, and we know about the contango and backwardation in the market when storage is at play. And as a result, what we've seen now with freight rates coming off sharply, as we see with US stocks, they've been coming down. Fujairah stocks, they've been coming down. But at the same time, China have been buying up stocks. You've got in Europe, the stocks are still quite high. There's a lot of jet fuel washing around in the market that still needs to be cleared. So in many ways in the market, yes, but it's so tightly traded. $40 barrels have been around for a couple of months, and in a volatile market when they've got such strong forces in demand and supply going on, that's an interesting time, and it shows how delicately balanced that oil market is right now. And when you compare it to some of the other commodities, for example, we had Philip on earlier about talking about gold and how that's hit highs. Copper, for example, as an industrial metal complex, that's been very strong because the demand out of Asia, out of China has been strong in terms of infrastructure spending, and even for oil up until a point has been strong. But at the same time, that now is reaching its limits, but with the metal side, that may not be there. So that is why the oil market is still in this very fine limbo.
That point is well taken, Carlos. I want a final comment from you on the same thing, because it really is about the Chinese demand for various commodities that has been driving the prices on the higher side. So when you look at the soft commodities, the huge stimulus measures, the weak US dollar, and the fact that the US and China are soon going to meet and talk about that phase 1 trade deal, how much of all of this impact has it had on the soft commodities?
Well, huge. I mean, in terms of, for example, soybean imports, China was importing a lot from Brazil, but now the quantities in Brazil are going down until the next harvest. We are at least 4 or 5 months away from it. So China needs to turn to the US. But regardless of geopolitics, I mean, the total import levels of China of soybeans have been beating expectations. We are back to levels before COVID and before African swine fever. That was a huge factor in the market over the last 2 years. And we are seeing record levels of imports there, and with the guidance to potentially even higher in the next season. And Chinese economy has recovered very well. There's no reason to believe pork demand is not going to continue to increase. Trade talks, of course, will be very closely followed by the markets. Whatever guidance we get from tomorrow's bio conference or any future meetings, that will be very closely monitored. But in the next few months, China will need to continue to buy soybeans, and the US is the only provider for the time being. And when we look at other commodities like sugar or corn, China was also increasing buying of those commodities.
Well, yes. China clearly seems to have made use of the recent times, and we've seen China buy a lot of commodities, and that has been one reason, apart from other factors that have led the commodity prices higher, and that could continue to support going forward as well. Paul, Carlos, thank you so much for joining us and giving us a sense on all of those commodities. With that, that's all the time that we have on Commodity Champions. Thank you for watching.